All right, Chapter 9, Activity-Based Costing. All right, guys, so we're in the home stretch of the semester now. We just finished test number 3, so our next test is going to be our last test, and that's going to be the final exam. So we're going to be going over Chapters 9, 10, and 11, which we're going to do in the next few weeks, and those will be on the final exam. So we just have a few weeks left in the semester, so congratulate yourselves on making it through this far. So if you recall, in Chapter 7, we talked about job costing, which is used by companies that provide unique services, unique products. We covered process costing in Chapter 8, and that's where costs are generally separated by department. Now we're on Chapter 9, and we're going to talk about activity-based costing. And in this method, we're going to break down costs by different activities or cost drivers. We're going to start off by looking at a company called Grange Boats, which we talked about in a previous chapter. This company makes sailboats, and according to the slide, it makes two types of sailboats. It makes their a C-27 line of sailboats, and they also make a line called C-20. Now, if you look at the slide, it shows that the costs are about the same. So the total costs for the C-27s is $198,400, and the total cost for the C-20s is $207,600. So altogether, it adds up to $406. Now, that's roughly about 50-50, right? Roughly half the costs are for the C-27s, and the other half are for the C-20s. Looks like overhead is about half and half as well. Not quite, not exactly half and half, but pretty close. If the total overhead is 180, they're putting 86 to the C-27s and 93 to the C-20s, and that's pretty close to half and half. And as the slide says, the company is considering dropping the C-27s. So this slide breaks down the overhead a little bit more. As we saw in the prior slide, total overhead was 180. And overhead, if they decide to drop the C-27s, is going to drop to 163,800. So a lot of people might have expected overhead to drop by half, right? If the original, which includes C-20s and C-27s, C-20s and C-27s. If the original includes two lines and you drop one, wouldn't it make sense for the overhead to also fall by 50% roughly? Well, in this case, it did not. Your total original overhead is 180, and if you drop one of the lines, it'll drop to 163,800. So that's only a savings of 16,200. So that's not a lot at all. So how is this possible? And this slide shows us about the same thing with the total costs. Remember, the original cost includes C-20 and the C-27s. So the total cost for those two is 406. And remember, they were about 50-50. But if we get rid of one of the C-27 line, costs don't get cut in half again. They just drop by not that much. They dropped to 277. If you cut them in half, it should have fallen to about 200. So these examples they demonstrate the effect of fixed costs, remember that there are some costs that will still be incurred no matter what in the short run. And so if you look at the prior slide, depreciation stays the same. Machine depreciation, if you do both C20s and C27s, is $29,550, and that's the same thing whether or not you do both the lines or just one. Plant depreciation is the same, miscellaneous is the same, and supervision is the same. So it looks like you are going to save a little bit on utilities and supplies and training, but the other costs, the supervision and the depreciation and the miscellaneous, are all fixed costs that aren't going to change anything if you drop one of the lines in the short run. All right, now how is this possible? I think a good example is let's say you're renting an apartment, all right, and you have a roommate. And this roommate, you split the utilities 50-50, and let's say your electricity bill is $200 a month, right? So that means that you pay $100 and your roommate pays $100. And let's say you and your roommate consume about the same amount of electricity. Well, one day your roommate decides to move out, so you might think, well, even though nobody's going to contribute, even though I'm going to have to pay the whole electricity bill myself nowadays after my roommate moves out, he's not going to be consuming as much electricity. I mean, the apartment as a whole is not going to consume this the same amount of electricity. It should fall by half. So my bill should also fall by half, right? Well, it doesn't quite work that way because even your electricity bill is going to have some fixed cost. So your bill will fall a little bit, but it's not going to fall by half. And the same thing would go for your cell phone bill. Some of you probably have experience with single lines versus family lines. So like for right now, I think T-Mobile charges about $70 total for a line. And then if you add another line, it doesn't go up by another 70, it goes up by 60. And then the third line is $20 and the fourth line is $20. So again, there's going to be some fixed costs in there, and you're going to get some economies of scale by adding more lines to a single plan. All right, so don't make the mistake that in assuming that when a company drops from two products to one product, then the cost will be cut in half. Most of the time, they won't. All right, the next slide talks about the death spiral. And it says that it's a process when your costs are going up, then you try to increase your sales price, and then what happens is the quantity demanded falls, and then so the company's business gets worse and worse as you try to increase prices. So to make that a little bit clearer for you guys, I want to first make sure you understand that there's an inverse relationship between price and quantity demanded. What does that mean? That means when price goes up, the quantity demanded goes down. All right, so for example, let's say that you own a hamburger restaurant. All right, your hamburgers are, you have $5 hamburgers, and you sell 100 a day. All right, at $5 you can sell 100 hamburgers, for example. So that means your revenue is $500 a day. All right. So one day you're looking at the books and records and you decide that you want to increase your revenue. You want to have more income than $500. So you decide to look into raising your prices. So you have to be really careful with this. So let's say you're considering to raise your prices to $6. So at $6, fewer people are going to want to buy your hamburgers. That's just economics 101, right? The cheaper you make something, the more quantity that's demanded, and the more expensive you make something, the lesser the quantity that's demanded. So at $6, you know that you're gonna sell fewer hamburgers, but you're not exactly sure how many fewer. So what you do is you study the market and you look at other hamburger restaurants that have sold burgers for $6, and you find out that similar restaurants sell about 80 burgers a day. So you tell yourself, well, we could probably sell about 80 as well. So you do $6 times 80, and your revenue actually goes to $480. So that means that your revenue went down, and you might want to reconsider your price increase. So at $5, you're making $500 of revenue. At $6 a burger, you're only making $480 of revenue. Of course, there's going to be other considerations like expenses and the costs of the materials, the beef and stuff that goes into the burgers. But just to make things simple, we're looking just at revenue. You raise your prices, and it actually caused revenue to go down. You know, you wish you could sell 100 burgers at the same price. You just raise your price in the same amount of burgers are sold, but that's not really how the economy works in real life. So if this is an accurate situation, then you would probably have to reconsider your price increase. Now, what if you did a study and it showed that a $6 burger would actually sell for you could sell 90 burgers, right? So so you're not going to sell 100, but you can still sell 90. And let's say you set it at the price, and you're actually selling at $6 each, and you actually do sell 90 burgers a day. So 6 times 90, that's $540. So your revenue actually went up. So so in this case, the data seems to indicate that it's probably a good idea to raise your prices, right? You raised your prices and you lost a few customers. You lost about 10 customers, but the price increase makes up for those 10 lost customers. Now, if you lose 20 customers, then that's not going to be a good thing. So going back to the slide and the example, the company's cost per unit went up after they shut down one of their product lines. So now they might be tempted to raise their prices, their sales price, to compensate for that. But as we just discussed, the price increase could actually hurt the company more than it helps, depending on whether how many customers they lose because of the price increase. So if the company loses more customers than what can be made up through the price increase, then the company's bottom line gets hurt. So the company might want to raise its price, try to gain more revenue from those customers that's stuck around with the company. And then what happens when the company raises prices again? Then now there's fewer customers, and so on and so forth. So that's what the death spiral is. When you keep raising prices to try to chase that cost per unit, and the more you raise prices, the fewer customers stick around. So there are two concepts to take away from this. One, as we've discussed, is that we need to be aware of how a price increase will affect our total revenue. As you saw here, depending on how many customers you lose, you might actually gain a little bit of revenue, or you might be losing revenue. The second concept is that cost does not necessarily dictate sales price. Okay, so talking about the death spiral, your costs per unit are going up because you're losing customers, and so your costs keep rising. Well, customers don't necessarily care about that. They're not going to just let you keep raising prices just because they feel sorry for you. They're gonna want the prices that they want. All right. So again, cost does not necessarily dictate sales price. So for example, let's say you're an artist. All right. Let's say you're an artist and you're making a painting, and it took you let's say it took you 3 years to paint the painting. All right, or make a statue, or whatever kind of artist you want to be. Well, hopefully you can. Hopefully you're a good artist, and someone will pay you hundreds of thousands of dollars because you spent 3 years of your life making this painting or this statue. But what if you're like me and you don't have an artistic bone in your body? Heck, I could spend 3 years on a painting and nobody's going to pay me anything for it. I could spend 30 years on a painting and I wouldn't get much money for it. So again, cost does not necessarily dictate sales price. All right, just because you spend a lot of time and money on something doesn't mean that the economy is going to care. There might not be any demand for what you're selling. So this is another reason why the death spiral can really hurt a company. The company's cost per unit is rising, and so they're trying to raise their sales price to keep their profit margin, but really that's not the way the economy works. All right, also in the chapter we're going to talk about the two-stage cost allocation system. First, costs are going to be allocated to departments, and we've done something similar to this in a prior chapter. And then second, we're going to allocate the department overhead costs to the products or services. So this should remind you of Chapter 6, where we discussed the two-stage approach to product costing. First, you gotta define the cost pools, and then the cost pool overhead. That overhead is separated into intermediate cost pools, machine-related costs and direct labor-related costs. And then finally, those costs from the intermediate cost pools, those are going to be allocated based on an appropriate allocation rule for each specific pool. So there's going to be some of the costs that are allocated by machine hours, and some of them are going to be allocated by direct labor costs. But we'll go through a problem like this in our homework, in the questions in the homework. We're also going to talk about plant-wide versus department-specific rates. We'll talk about the plant-wide allocation method. The companies that use a plant-wide allocation method, in those types of companies, all overhead costs are recorded into one cost pool and then applied to products using one overhead rate. So as you'll see in the homework, when you just do one cost pool, a lot of times you're not doing a very accurate type of allocation. It still works, and at the end of the day, everything is going to balance out, but certain products or services might be allocated too much of a certain cost. So the plant-wide allocation method, it's simpler, of course, because you only have one cost pool for the whole factory, but it's not as accurate. When you're doing the department allocation method, overhead costs are traced to separate departments, and then they're applied to products using the department allocation method. So in a situation in a company like this, there's one cost pool for each department, but there's going to be at least two or more departments in this case. So it's slightly more accurate than the plant-wide allocation method, because again, the plant-wide allocation method just uses one cost pool, but in the department allocation method, it could be two or more, because you're going to have several departments in a single company. So depending on what kind of company you have, what kind of industry you're in, a plant-wide allocation method might be better or more efficient than a department allocation method, or vice versa. So so it really depends on what type of industry you're in. That'll determine which cost allocation method is appropriate. So if the products that you're making are similar and they use the same resources, then you might use the plant-wide allocation method. And if the company is making very different types of products that uses different resources, or maybe the same resources but they use them differently, then the two-stage allocation method might be better. It just depends on what kind of business you're running. So what about ABC, or activity-based costing? So activity-based costing, that's going to be a type of two-stage allocation method. First, you're going to assign overhead costs to activities rather than departments. And then you're going to allocate the cost of those activities to products based on the use of each activity. So it's very, very, very similar to allocating per department, as we've already done in prior chapters. But instead of allocating, in this case, to departments, we're allocating to activities. So why would we allocate to activities? Well, we allocate cost to activities because activities consumes resources, and products consume or use activities. So, like I said, it's very similar to when we're splitting the costs by department. Each department is going to consume a certain amount of activities or resources, and activities are going to follow a similar pattern. So this should look very similar to what we've seen in prior chapters. When we're doing activity-based costing, we're going to identify the activities that consume the resources and assign costs to them. 2, identify cost drivers. 3, compute a cost rate per unit. And then 4, assign the costs based on that cost rate per unit. So again, very, very similar to what we've already been doing in past chapters. So again, one of the things we need to do is identify activities. Here they've identified 4 different activities: setting up machines, handling material, machining, and packaging and shipping. These are activities, but they could also be departments, right? I mean, you could have a machine setup department, you could have a packaging and shipping department. So again, it's very similar to splitting costs by department like we've done in the past. In this case, instead of looking at the cost driver, which cost driver is a factor that causes or drives an activity's cost, we could be looking at departments. So in this case, like let's take setting up machines for an example. The company has decided or looked into it and decided that the cost of setting up a machine is related to the number of labor hours needed to prepare the equipment. So in this situation, the cost driver for that would be labor hours. So basically, the company tries to tie 2 different costs together. In this case, they're trying to tie labor hours to setting up machines, and that does look like a pretty accurate pairing. So it should result in fairly accurate allocations of cost to each product. So here's another illustration of the cost flow of activity-based costing. The first thing we do is we identify the activities that consume resources. So it looks like setting up machines, handling materials, machining, and packaging are all activities that consume resources. We're going to assign costs to them, and then we're also going to identify the cost drivers associated with each activity. Step number 3, we compute the cost rate per driver, and then finally, number 4, we allocate the cost of the activities to products, and we do that by multiplying the cost driver rate by the cost driver units consumed by the product. So again, this is all very similar stuff to what we've done when we're allocating by department, but in this case, we're allocating based on activities. So as you can imagine, depending on the different methods you use to allocate costs, you're going to come up with some very large, some very different answers. All right, so in this case, when they're using a plant-wide rate, remember when we're doing plant-wide rates, you're using a 1 cost pool for the entire plant. It's allocating $48 per unit of J25P and $105.60 for J40X. When you split it by departments, it looks like it gets a little bit more accurate. It looks like J25P actually doesn't use as much overhead as it initially thought, so J40X is going to be allocated a little bit more of the cost. And then finally, when you get to activity-based costing, it's even more accurate because you're breaking it down further. Instead of just breaking it down by department, you're breaking it down by activity. So the cost calculations further get refined, and so J25P ends up being allocated only $39.12 instead of the original $48.06. So now this isn't necessarily typical that you see such a clear pattern like this, but it could happen. And also understand that sometimes the numbers will go up and sometimes they'll go down. So for J25P, it looks like it was being allocated $48 a unit using the plant-wide rate, and then using activity-based costing, the cost per unit actually fell. So that means that the profit margin on these units looked better. right? Because it's costing you less, so whatever sales price you set, you're making a little bit more of a profit percentage-wise. But the opposite is true for the J40X product line. So originally it looked like it was fairly, let's say, cheap or affordable, that it was only costing $105.60 for one of these items. But after refining your calculation, you realize that it's really closer to 127, 128 when you're doing activity-based costing. And then finally, when we're doing ABC costing in administration, it's going to be the same thing. The same thing as the prior slide. You got to identify the activities that consume resources, identify the cost driver, calculate your cost rate per cost driver for each unit, and then assign the costs. So again, it's very similar to what we've done, and this four-step process is the same four-step process that we did a few slides earlier. It doesn't matter whether you're doing administrative services or another different type of industry, the same four-step process for ABC costing will be about the same.